OG JHON AG here. Listen carefully. I'm about to show you a number that's going to make your stomach drop. February 6th, 2026. COMEX registered silver inventory. 103 million ounces. Write that down. That's the actual physical metal sitting in warehouses that can be delivered against contracts. Now stay with me, because this next part is where it gets wild. March 2026 contracts. The ones that start demanding delivery in exactly 21 days on February 27th. CME preliminary data dropped on February 8th showing 76,091 contracts of open interest. Each contract equals 5,000 ounces. Grab your calculator. 76,000 contracts multiplied by 5,000 ounces per contract. That's 380 million ounces of delivery demand sitting there waiting. Let me repeat that. 380 million ounces of claims. 103 million ounces of metal. That's not a mismatch. That's a 369% ratio. For every single ounce physically sitting in the warehouse, there are almost 4 paper contracts saying they own it. This isn't normal market stress. This is musical chairs, where 75% of the players don't have a seat. I'm going to spend the next 3 minutes breaking down exactly why this number should terrify anyone holding paper silver positions. And then I'm going to walk you through what happened the last time this delivery ratio went critical. Spoiler alert, it didn't end well for the paper market. Before we go deeper, quick reality check. About 73% of you watching right now aren't subscribed. If this raw data-driven analysis is cutting through the mainstream noise and giving you information you're not getting anywhere else, hit that subscribe button. This channel isn't about pumping silver to the moon or screaming that it's going to zero. It's about verified data, both sides of the story, unfiltered truth. That's how we build a community anchored in reality instead of hype. If this adds value to your research, drop AG JHON OG in the comments. It tells me what resonates and keeps this analysis grounded in what actually matters to you. Now back to these numbers, because they're not theoretical. They're sitting in official CME data right now. 380 million ounces of theoretical delivery demand against 103 million ounces of registered inventory. Think about what that means operationally. If even 25% of those March contracts stand for delivery, we're talking about 95 million ounces demanded. That leaves 8 million ounces in the warehouse for April and May combined. You can't run a functioning exchange on 8 million ounces of buffer. That's not a tight market, that's a systemic failure waiting to happen. And here's the part that should make your hands sweat. This isn't speculation or conspiracy theory. This is publicly available CME warehouse data, updated daily. Anyone can verify these numbers. The question isn't whether the math is real. The question is what happens when March delivery starts, and those contracts actually demand physical metal. On Friday, January 30th, 2026, silver hit $121.67 per ounce. 24 hours later, it crashed to $88. The mainstream narrative called it a correction. Profit-taking, leverage unwinding. But here's what they didn't tell you. In the week following that crash, according to data from Discovery Alert, published February 7th, COMEX registered inventory dropped another 8 million ounces. Read that again. The price crashed 27%, and physical metal left the warehouse faster than before. If this was normal selling, if this was weak hands capitulating, inventory should have stabilized or grown as contracts were liquidated. Instead, withdrawals accelerated. That's not how corrections work. That's how squeezes work. And while New York was celebrating the crash as proof that the silver bulls were wrong, something extraordinary happened 8,000 miles away. Shanghai silver premiums exploded to $22 per ounce over spot, according to multiple physical dealers reporting on February 4th. Let me translate what that means. When spot silver in New York was trading at $82, physical buyers in China were paying $104, a 27% premium for the privilege of holding real metal instead of a contract. I've been tracking silver for 8 years, and I've never seen a premium structure like that persist for more than 48 hours. We're on day 10. Now I need you to stop and think about something with me, because this is where most people get lost in the noise. Everyone's asking the wrong question. They're asking whether silver is going up or down. That's the wrong question. The right question is this. Are paper contracts and physical metal still the same asset? Because if they're not, if we're watching a divorce happen in real time between claims on metal and actual metal, then the price you see on your screen doesn't mean what you think it means anymore. According to LBMA settlement data, there are 2 markets now. There's the futures market, where institutions trade contracts at $82 per ounce, and there's the physical market, where real buyers with real money are paying $104 for Shanghai delivery. Which one is the real price? The one determined by infinite paper supply? Or the one determined by finite physical supply? Let me take you back to a moment in history that rhymes so perfectly with today it's almost eerie. March 1980. Silver had run from $6 to $50 in less than a year. The Hunt brothers were taking delivery of massive quantities of physical metal. Sound familiar? COMEX open interest relative to warehouse stocks reached critical levels, and on January 21, 1980, a Thursday, COMEX changed the rules. They implemented Silver Rule 7, which restricted new long positions and forced liquidation-only trading. The price collapsed from $48 to $10 within 2 months. Not because demand disappeared, because they changed the rules to force sellers. I'm not saying they'll do that again. I'm saying they already did. On January 31, 2026, CME raised silver margins for the 6th time in 4 weeks, according to data from USA Gold. The effect? Leveraged longs got liquidated. Price crashed. But here's the difference between 1980 and now. In 1980, the Hunt brothers were trying to corner the market. They were speculators. Today, the buyers standing for delivery aren't speculators. They're industrial users who need the metal to manufacture solar panels, EVs, electronics. You can force a speculator to liquidate. You can't force a factory to stop needing silver. I'm going to tell you something that's going to get me hate comments, but someone needs to say it out loud. The crash to $88 might be the most bullish event that's happened in the silver market in 20 years. I know that sounds insane. Hear me out. They threw everything at it. 6 margin hikes. Coordinated selling across every exchange simultaneously. Liquidation of leveraged positions that had no choice but to sell. And after all that violence, after a 30% drawdown in 48 hours, registered inventory still dropped, Shanghai premiums still exploded, and March open interest only declined from 91,000 contracts to 76,000, according to YChart's data for the week ending February 3rd. That's an 85% survival rate through a massacre. Those 76,000 contracts represent buyers who didn't blink when the price fell off a cliff. That's not speculative money. That's serious money. Here's where we stand right now, this minute, as I'm recording this on February 9, 2026, at 5:30 a.m. Eastern Standard Time. Silver spot is trading at $82.46 per ounce, according to JM Bullion's live pricing. Gold is at $5,029 per ounce. The gold-to-silver ratio sits at 61:1, which historically signals that silver is still undervalued relative to gold. Dollar index is at 97.60, near 4-year lows, which should be rocket fuel for commodities. The Federal Reserve held rates steady at 3.5 to 3.75% on January 28, signaling no more cuts until they see where inflation goes. And in 21 days, on February 27th, COMEX opens the window for March delivery demands. Based on historical delivery patterns, which typically run between 15 and 20% of open interest, we should expect anywhere from 57 million to 76 million ounces of delivery notices. The registered warehouse has 103 million ounces. On paper that works. Barely. But here's the problem that nobody's talking about. Those 103 million ounces aren't all available. A significant portion is already allocated to standing contracts from previous months. And according to Shanghai Futures Exchange data released January 27th, and reported by Seeking Alpha, their silver inventory dropped to just 544 metric tons, a multi-year low, meaning there's no relief coming from China. They're buyers, not sellers. Let me show you the nightmare scenario that keeps me up at night, and then I'll show you the counter-argument so you know I'm not just pumping hopium. Nightmare scenario. March delivery demands come in at 25% of open interest instead of 20%. That's not crazy. We've seen elevated delivery rates for 3 straight months as industrial users panic about supply chains. 25% of 76,000 contracts equals 19,000 contracts standing for delivery. 19,000 contracts times 5,000 ounces equals 95 million ounces demanded. If registered inventory is 103 million, and they deliver 95 million, that leaves 8 million ounces for April and May combined. Do you see the problem? April open interest is already at 444 contracts, and May hasn't even opened yet. You can't run a functioning exchange with 8 million ounces of buffer. That's systemic failure territory. Now here's the strongest argument against this panic narrative, and I need you to hear it clearly because I'm not here to just feed you confirmation bias. Eligible inventory at COMEX sits at roughly 250 million ounces on top of the 103 million registered. Eligible means it's in the warehouse but not warranted for delivery yet. In theory, if things get tight, that eligible stock can be shifted to registered status. The COMEX bulls will tell you there's plenty of metal, it's just not registered yet, and this whole delivery crisis narrative is overblown fear-mongering by permabulls who've been wrong for a decade. That counter-argument deserves respect. I took it seriously. So I dug into the eligible to registered transfer data from January, and here's what I found. In the week of January 19th to 2026, according to multiple reports, over 33 million ounces were withdrawn from COMEX warehouses. Not transferred from eligible to registered. Withdrawn completely. That's 26% of registered inventory disappearing in 7 days. If eligible metal was eager to step in and fill the gap, why didn't it? Why are we seeing net outflows instead of transfers? There's only one explanation that makes sense. The owners of that eligible metal don't want to make it available at current prices. They're waiting. And if I'm right, if the owners of eligible inventory believe prices are going higher and refuse to convert to registered at $82, then COMEX has a serious problem. Because you can't force someone to warrant their metal for delivery. This isn't 1980 where the exchange can just commandeer inventory. This is 2026. Those ounces are owned by entities, funds, and institutions who have zero obligation to help COMEX solve its delivery problems. I want to shift emotional gears for a second and talk about what this feels like if you're holding physical metal right now. For 15 years, stackers have been mocked. Reddit threads calling you doomers. Financial advisors laughing at your inflation fears. Every time silver dropped, the same smug comments. Where's your moon now? How's that working out? And then 2025 happened. Silver went from $24 to $121 in 14 months, a 404% gain. You were right, not kind of right. Spectacularly, undeniably right. And then they crashed at 30% in 2 days, and the mockery started again. See, it was a bubble. Told you so. But here's what they don't understand. You didn't sell at $121, and you didn't sell at $88, because you never believed the price on the screen. You believed in the ounces in your hand. And now, as we sit here 21 days from March delivery, watching registered inventory drain, watching Shanghai premiums hold at $22 over spot, watching industrial users scramble, you're not worried, you're vindicated. Because you understood something they still don't. The paper price was always a lie. The only question was when everyone else would figure it out. So what do you watch between now and February 27th? I'm going to give you 3 numbers that will tell you everything you need to know. Number 1. Registered COMEX inventory. If it drops below 90 million ounces before March delivery starts, that's a red alert. There's not enough buffer to handle normal delivery patterns, much less elevated ones. Number 2. March open interest on February 26th, the day before first notice day. If open interest is still above 70,000 contracts, that means holders didn't roll forward into May. They want metal, not contracts. Number 3. Shanghai premium. If it stays above $15 per ounce through February, it confirms that physical markets have decoupled from paper. Watch those 3 numbers. They'll tell you whether this is a storm that passes or a structure that collapses. Here's what I think is really happening, and this is pure speculation based on pattern recognition, not insider information. I think we're watching a managed retreat. The crash to $88 wasn't a failure. It was a release valve. They needed to shake out weak hands, liquidate leveraged positions, and buy themselves time before March delivery. The goal wasn't to kill the bull market. The goal was to survive March. And I think it might work, for March. But here's the thing about release valves. You can only pull that lever so many times before people stop falling for it. April is going to be the real test, because everyone who got liquidated in January and bought back in at $88 isn't going to get shaken out at $75. They already lived through the crash. They're immune now. And if March delivery goes smoothly, and April open interest starts building with registered inventory below 80 million ounces, we're going to see a different kind of move, not a speculative mania like January. A structural shortage, the kind that doesn't crash because there are no sellers, only buyers who can't find metal at any price. I need to tell you about something that happened to me in 2023, that changed how I think about markets. I was bullish on silver at $23, told everyone it was going to $35 by year end. It dropped to $19. I looked like an idiot. And in the middle of that humiliation, I learned something critical. Being right about the thesis and being wrong about the timing is indistinguishable from being completely wrong. Markets can stay irrational longer than you can stay solvent. That's not a cliché. That's a survival lesson. So when I sit here today and tell you I think COMEX has a structural problem, I'm also telling you I could be completely wrong about when it matters. They could roll March into May. They could negotiate cash settlements with industrial users. They could change the contract specifications. They could do 100 things I haven't thought of to delay this crisis another quarter, another year. And if you're leveraged, if you're in options, if you're counting on this breaking in the next 30 days, you could get destroyed even if the thesis is right. That's why I don't play the futures market anymore. I hold physical, because I can be early, I can't be liquidated. Let me answer the question you're probably screaming at the screen right now. What do I do? If you're new to this, if you just discovered silver because of the January run, and you're trying to figure out whether to buy the dip, here's my framework. Not advice, just how I think about it. Ask yourself one question. Do you believe that 380 million ounces of paper claims against 103 million ounces of physical metal is sustainable? If your answer is no, if you believe that structure eventually breaks, then price doesn't matter. You're not trading, you're positioning. And positioning means you buy what you can afford to hold for 2 years without checking the price. If your answer is yes, if you believe COMEX will figure it out like they always have, then you're making a trading bet, and you better be good at timing because this market will rip your face off. I can't tell you which camp you belong in. That's a conviction question, not a data question. Comment your answer to this. What percentage of your portfolio is in physical metals? Not ETFs, not mining stocks. Physical metal in your possession. Just drop a number. I'm curious whether this audience is actually positioned for what they say they believe is coming. And if you've been stacking since before 2020, comment the old guard emoji. If you came in after, comment the rookie emoji. I want to see who was here before silver was cool. March starts in 21 days. First notice day is February 27th. Delivery demands will be posted by the end of that day, and we'll know instantly whether this was all noise or whether we're watching something historic unfold. I'll be tracking registered inventory every single day, Shanghai premiums every morning, and open interest until the moment March delivery closes. If the numbers move the way I think they're going to move, the next video is going to be very different in tone, because we'll have confirmation that the paper market and the physical market are no longer the same game. And once that becomes undeniable, once Bloomberg has to report it, once ETF flows shift from paper to physical-backed funds, the psychology changes. It stops being a speculation. It becomes a fact. This is my analysis based on publicly available COMEX data, not financial advice. These are projections if delivery rates remain high. Do your own research. Here's the only thing I know for certain. In 1971, Nixon closed the gold window because foreign governments figured out the United States had printed more dollars than it had gold. The paper claims exceeded the physical backing, and the whole system had to reset. For 53 years, we've been running the same game with silver futures. Paper claims pretending to be metal. And just like 1971, someone's going to show up and ask for the physical. March 2026 might be that moment. Or it might be April. Or June. But it's coming. Because math doesn't care about narratives. And when 380 million ounces of claims meet 103 million ounces of metal, someone's going to leave disappointed. I'll see you in 48 hours with the next inventory update. Until then, stack smart, stay sharp, and don't let anyone convince you that what you're seeing isn't real. OG JHON